Warren Buffett, one of the best investors the world has ever seen, always has some investing strategies that can alter your life in a positive way. The only thing is, we have to follow up as it is like he says. Well, in this video, we have 6 investment tips that can be used by low-income individuals to gain profits. Let's dive deeper. Number 1. Focus on the forest, forget the trees. Warren Buffett recommends us to approach investments with a simple yet effective strategy. Focus on the forest rather than the trees. In his 2018 letter to shareholders, he utilized the forest metaphor to demonstrate how investors might simplify their decision-making process. Consider a corporate group to be a big, interconnected forest, with each enterprise represented by a tree. Buffett says that instead of getting caught up in the detailed branch of each tree, investors should take a step back and assess the general health of the forest. This viewpoint promotes a holistic approach, emphasizing the group's overall performance rather than evaluating each firm individually. According to Buffett, if the general health of the business forest is strong, investors do not need to assess each individual tree. It streamlines decision-making, allowing investors to focus on the larger picture, growth, and sustainability. Buffett's wisdom is in realizing that firms within a group can vary greatly, but the success of the overall company is what matters the most. It's like recognizing the overall strength of the forest ecosystem rather than focusing on individual trees that may encounter issues. This strategy saves time and money, allowing investors to make informed judgments based on the corporate group's overall health and prospects. He believes that the forest, a company's aggregate strength and future, is the most important indicator of a good investment decision. By taking this approach, investors may navigate the complex world of investing with a sharper emphasis on long-term success. Number 2. Focus on earnings, not adjusted earnings. Warren Buffett has a unique approach to investing, emphasizing the importance of focusing on actual profitability rather than adjusted ones. One major point he makes is that some corporations utilize adjusted EBITDA in their presentations rather than EBITDA, a figure that removes certain charges. Buffett warns against such changes, using the example of calling a dog's tail a leg. In his 2018 shareholder letter, he invoked Abraham Lincoln to emphasize the issue, saying, "If you call a dog's tail a leg, how many legs does it have? 4, because calling a tail does not make it one." Buffett's illustration is an earnest reminder that renaming or altering terms doesn't affect the fundamental fact. Similarly, just because some costs are removed from adjusted results does not imply that they have no impact on the company's financial health. He highlights a tendency of certain managers to remove stock-based remunerations from expenses, highlighting the importance of openness and an accurate portrayal of a company's financial picture. For Buffett, the fundamental concept is simple. Actual earnings provide a more accurate representation of a company's performance. Investors can make better selections if they avoid modified numbers that may underestimate costs. In layman's terms, he advocates for a basic, no-nonsense approach to analyzing investments, similar to recognizing a dog's tail for what it is, a tail. His insight encourages investors to cut through financial jargon and focus on the fundamental components of a company's earnings, resulting in a more accurate appraisal of its financial position. Number 3. Being cash rich keeps you safe and secure. Warren Buffett takes a unique approach to investment management, which he publicly shares with the public. One major part of his method is the significance of having a large cash reserve, which he believes provides certain protection and security in the uncertain world of finance. Simply put, being cash rich is having a significant quantity of money on hand, similar to a financial safety net. Buffett's company Berkshire Hathaway adheres to this principle by retaining a large number of treasury bills and other cash equivalents. These are readily available and may be rapidly turned into cash as required. In his own words, he underscores the need of having enough cash to deal with any unexpected issues in the future. This is similar to having an emergency fund for personal finances, a pool of money set aside to cover unexpected expenses. What distinguishes Buffett's plan is his determination to keep a portion of his cash reserves untouchable. He is committed to have at least $20 billion in cash equivalents at all times as a precaution against external disasters. This approach represents a cautious yet prudent perspective, ensuring that Berkshire Hathaway has a strong financial base to weather market storms or broader economic uncertainty. Individuals and businesses who are cash rich may traverse difficult times with confidence, knowing that they have the financial wherewithal to overcome unanticipated challenges. It's a practical technique that emphasizes the value of financial resilience and being prepared for whatever the future may bring. Number 4. Importance of retained earnings. In his 2019 letter to shareholders, he mentioned Edgar Lawrence Smith's 1924 book, Common Stocks as Long-Term Investments. This book, which was evaluated by the prominent economist John Maynard Keynes, highlights an important subject. Smith claimed that well-managed businesses do not distribute all of their profits to shareholders each year. Instead, in good times, they retain some of their earnings and reinvest them back into the business. Why? Because there's something magical going on here, much like compound interest working its magic on a smart business investment. Now, let's break it down. Assume a corporation produces money, and instead of distributing it entirely to its shareholders, it keeps a portion. This allows the organization to use the funds to grow, expand, and generate even more revenue in the future. It's similar to sowing seeds and letting them grow to create additional seeds. Warren Buffett finds it perplexing that, prior to Smith's book, many investors were unaware of the importance of retained earnings. He considers it an important approach because it allows businesses to reinvest in themselves, something which promotes long-term success. It's more than just making money today, it's about laying a solid basis for the future. So when you read about retained earnings in relation to Buffett's investment philosophy, consider them to be a company's means of saving and reinvesting in itself, resulting in a long-term growth ripple effect. Number 5. Risk evaluation. Warren Buffett prioritizes disciplined risk evaluation at his company Berkshire Hathaway. In his 2019 letter, he compared this activity to religious devotion, drawing parallels to the Old Testament. This daily attention on risk assessment is more than just a habit for Buffett and his team of insurance managers. It's a guiding philosophy that is deeply embedded in the fabric of their decision-making process. To comprehend this Old Testament-style approach, consider it a firm commitment to prudence and caution, similar to biblical adherence to laws and values. In Berkshire Hathaway, risk assessment is more than a duty, it's a basic belief system. This attitude entails a thorough examination of potential hazards and uncertainties, ensuring that each investment decision is made with a strong understanding of potential negative consequences. Buffett's analogy demonstrates his commitment to learning from history and adapting techniques properly. Simply said, it's about adhering to tried and true principles and remaining attentive in the face of uncertainty. Approach to risk evaluation is a rigorous, unchanging technique that demonstrates the long-term performance of one of our time's most recognized investors. Number 6. Don't invest for the sake of it. Consider this. His company, Berkshire Hathaway, accumulated $144 billion in cash and equivalents. Why? Because according to Buffett, there were no compelling chances in the market to put that cash to good use. Now, let us convert this wisdom into common language. Buffett effectively advises investors not to enter the investment game solely for the sake of it. Imagine having a large sum of money and the desire to invest. But Buffett says, hold on a minute. It's like having a suitcase full of money and waiting for the proper time to use it wisely. Buffett's counsel is clear. Do not invest simply because you have the funds. Instead, wait for the proper chance to present itself. It's similar to being a clever shopper who doesn't buy the first thing they see and instead waits for a fantastic offer. In the realm of finance, it refers to being selective and strategic about where you invest your money. Consider it as a kindly reminder from the seasoned investor himself, much like your wise uncle telling you not to spend your hard-earned money on hasty purchases. So if you have money to invest, follow Buffett's advice and resist the impulse to dive in until you find an investment opportunity that corresponds with your goals. It comes down to being patient, strategic, and putting your money to work as efficiently as possible. Thank you for watching, and if you enjoyed watching our content, then do like, share, and subscribe to our channel. Don't forget to comment your thoughts below.